Welcome to Innova's November podcast. My name's Dan Miles. There's been a lot of price action in markets, so this is a timely period to go through markets at present. For those that have any questions post listening to the podcast, you can either email or call Innova directly. Please note that because these podcasts are recorded, we won't talk about any managers or strategies specifically, but questions regarding those managers or strategies can be asked of us directly if you wish. So please be aware that nothing in this podcast is given as personal advice. It's been designed for viewing by professionals only, and anyone wanting to make any investment decisions should do so under the guidance of a licensed advisor. Okay, so one of the most topical areas of the market has been the US Treasury bond market. So since the early 90s, this has been the go-to market whenever there's been any weakness in equity markets, and until 2016 was in a 30-plus year bull market. So it's the reference market for almost all other fixed rate bond markets, which is why it's quite topical at the moment. It's used for setting the discount rate on equities, the interest charge on fixed rate loans, not necessarily here in Australia, but it's used as the reference rate for credit card rates, mortgages, etc., and is the primary rate used for the risk-free rate in many financial transactions or calculation of the future value of cash flow streams. Not by everybody, it's not necessarily the risk-free rate depending on where you're coming from, but by many participants. But as you can see from the chart, it's been a lot more volatile in the recent period than it has historically. In particular, at the start of October, yields jumped to 3.24%, which meant the price fell. So on the chart, we've actually got the price movement, not the yields. And the yield moving to 3.24% is the area in the circle. Now, if you look at the chart, there have been other falls as indicated by the arrows, but these didn't coincide with big sell-offs in the equity market the way the October occurrence did. So what was the difference between the start of October and these previous rises in yields and hence sell-offs in bonds? And that's around, that kind of exists around the yield level that actually occurred. So in October, at the start of October, yields broke past what was a key breakout and resistance level at 3.12%. So if you rewind back to around June, there was, for people who are interested in technical market signals, there was a resistance or breakout level at 3.05% yield. And in June, the 10-year Treasury yield moved out beyond that to 3.12% before retreating back. That became the new breakout resistance level, which it broke out above at the start of October. And we saw prices fall quite dramatically. Then at the start of November, they then rallied again. At the start of November, yields broke out again. They reached above 3.2, and then more recently we've seen them whipsaw back with yields retreating and prices going up, which is not typical of this sort of market, but is why it's been quite topical and why people have been talking about it. So why are they bouncing around? Why is this occurring? There's a couple of reasons. First and most obviously, the Fed is tightening, which is what this chart displays up at the moment. They're almost 2 years into their tightening cycle, so this is obviously going to have an effect on yield. If they're increasing the Fed funds rate, that's going to have an effect on the longer end of the curve as well. Second, wage price inflation is starting to show itself in the development world. We're seeing strength in wage price inflation, not only in the US, we're actually seeing in the UK, Europe, and believe it or not, even Japan, which hasn't seen wage price inflation for decades. But probably most poignant of all is that there's question marks around the sustainability of US budget deficits. So whilst when you invest in fixed rate bonds, you're worried about inflation because the fixed rate of interest you get becomes less valuable in a higher inflationary environment because your coupons are fixed. There's also a question mark about whether you're receiving, at the moment there may be a question mark about whether you're receiving an adequate amount of yield for the risk you're taking on, given that the counterparty is the US government and they're currently running a budget deficit at about 3.5% of GDP. They're doing that at a time where their economy is exceptionally strong. It's taken a while since the GFC for the economy to really fire on all cylinders, but it is at the moment. And normally in boom times, like the US is in, you try to run a budget surplus, so you have some spare money set aside during times of the inevitable downturn. But instead, the US issued a corporate tax cut, which has been well covered, and they have a proposed infrastructure spend in place. Now, with the Democrats seizing control of the House, any proposed bills have to be passed by both sides of Congress, but the Democrats are pro an infrastructure spend. So this, if it is passed, could take the deficit out to, say, 5 or 6% of GDP, and that's in a strong GDP growth environment. If a recession occurs, you're now talking about, potentially the vicinity of 10% deficits to GDP, which post-World War II was only seen in 2008, 2009, and so there's question marks around the sustainability around that, and therefore whether a sufficient yield is being received on these longer duration bond instruments. Now, you almost can't go a week without hearing about trade tensions between the US and China. This has received a lot of attention and was another reason for the gyrations in markets in October and then continuing in November. There seems to be a lot of noise and misunderstanding, though, around this, and it's often by people who should know better. So we'll go through a few things that don't seem to be reaching the press as frequently as they probably should. So there are fears that the trade tensions are inflationary for the US. Well, the US dollar has appreciated some 7% against its major trading partners. Now, if you think about that, that's going to offset any increased prices due to the tariffs themselves. And the tariffs have primarily been placed on imports from China, yet China only accounts for 22% of US imports anyway. Yet the rising US dollar the US dollar has risen against essentially all trading partners, and so it affects all imports, meaning that the rising dollar more than offsets the tariffs that have been placed on Chinese goods. So we're not going to see inflation in that regard in the US. So that has probably been overblown by the broader marketplace. If we look at it from China's point of view, and they have copped a pasting, their equity market up until November copped a very serious downdraft. The renminbi has dropped over 9%. So the renminbi, being the Chinese currency, has dropped over 9% against the US dollar, offsetting the cost of the tariffs placed on their exports to the US. So a hit to their economy or their broader populace is likely only to come in the form of any tariffs placed on US imported goods by the Chinese government, because the price of any goods that are imported in US dollars. And China is a net exporter, so net they're better off. So due to the fall in currency, raw commodity inputs are going to be more expensive because they're imported as US dollars. That's obviously not going to be great for the economy. And US goods are more expensive with the tariffs added and with the fall in the renminbi. But one of the primary commodity inputs that is not then necessarily used as a raw material to produce something that is then exported by China is oil. And oil has obviously fallen off a cliff. So we've seen the price of oil fall a long way, which goes a long way to reduce the net effect of those increased import costs. So another area of misunderstanding in regards to US and China trade tensions, global trade flow is, whilst it's not the highest it's been in recorded history, it is still as high as it's been in generations. So if we look at duties collected as a percentage of total imports, they were slightly higher earlier this century, but right back to the late 1800s, we haven't seen percentages this low we haven't seen the percentages this low in recorded history. So even with trade tariffs and a reduction in duties collected, sorry, not a reduction, an increase in duties collected, and so therefore a restriction of trade, we're coming off a very, very loose base to begin with. Also, in reality, there are other economies who are likely going to be hit harder by trade restrictions than China and Asia, even though the emerging markets, China and Asia in particular, are the ones who have copped the brunt of investors' ire. And finally, we kind of suspect, and this is the reason for this chart that's up on your screen at the moment, we kind of suspect that the trade talks from the US is more about China's Made in China 2025 initiative and the One Belt, One Road initiative than anything else. The US is fearful of China rising as technological, quantum computing and artificial intelligence powerhouse, given that that mantle largely sits with the US. And the US is concerned that they will lose that control and that monopoly to China. The reality is, and the problem is, that China may already be a powerhouse in this space at the level that they can rival the US. So the horse may have already bolted, and so these sorts of trade negotiation tactics may be a false or inappropriate way to an inappropriate measure, because it's already too late to try and prevent China from eating away at the US dominance in this area. So, on that, on a related topic, Innova has had exposure in some of our client portfolios to Asia and emerging markets. We've received a few questions in regards to performance recently, but predominantly it's been less around our exposure to emerging markets and more around our exposure to alternatives. And so you should be receiving a weekly blog from us where I go into an extended commentary on our process, what we've had in our portfolio, and I talk in more detail about alternatives. But I thought I'd touch on it in the podcast today. So if you get a chance, please read my weekly blog to get some context about performance. I'll give a very brief summary here. We follow a process that involves selling out of assets as they get more expensive, so reducing those exposures over time and increasing exposures to assets that are cheaper or more attractive. And then when uncertainty is high and potential returns are subdued, diversifying our positioning or clients' positioning. And when your confidence is high and the upside investments is high, concentrating those portfolio positions. Given the uncertainty attached to investments of the last number of years, we've been more diversified than we normally would, and this has meant that we have allocated to alternative sources of return where we've believed that to be appropriate. But unfortunately, some of those allocations have not performed particularly well in the recent environment. And we can understand where the questions are coming from, because if equity markets are down, it's fairly easy for people to point to equity markets and say, oh, equity markets are off, that's why they haven't done so well. But if alternatives have not done particularly well, you can't point to a particular market and say, right, that's the reason why alternatives are down. So hence the reason for the questions. And there are also some common misconceptions around alternatives that I'll address. So one of the questions we've been asked about is that why are some of the alternatives showing the returns that they have? Because there's a perception that alternatives in general are low volatility. That's not the case for alternatives. Some alternatives are low volatility, some are very high volatility. They're quite aggressive. They're as volatile as your most aggressive equity markets. So you would expect somewhere between the 16 to 22% annualized volatility mark. And so those sorts of alternative assets have the same sort of bear markets as you can see in equity markets. But they've got the same sort of return profile or potential upside as equity investments as well. And so yes, you could have a 12-month period of a 50% loss. We haven't had one yet, but it's certainly possible. Maybe not a 12-month period, but maybe over a 2 or 3 year period, but you can absolutely get those 20, 30 and 40% annualized returns from them as well. But they're not all low volatility investments. Some of them are high volatility investments, and so we reduce the allocation to them accordingly because of that. There's also a view that alternatives are negatively correlated to equity markets. So if equities go down, they will go up. That's the case for some alternatives. There are some alternatives we don't allocate to them. There are some alternatives that are actually positively correlated with equity markets, and in fact, we don't consider them alternative because we believe they're harvesting the same premia as either equity markets or property markets, and so we don't believe they're alternative. But there are obviously a select group that are negatively correlated to equity markets, but the majority, and the ones that we use in general, are not correlated to equity markets. So if equity markets fall, they may make money, they may lose money, or they may not do anything at all, but their direction is dictated irrespective of what happens in the equity market. So on average, if we go through 10 bear markets, they should lead to a positive return in those 10 bear markets, but in some of them they'll be down and in some of them they'll be up. The reason why on average they should get you a positive return is because the last point there, we're only allocating to those alternative assets that have a persistent, statistically significant and long-term positive premia attached to them over the long term, but they do have negative periods throughout time, which is unsurprising. What we have had is a period in which a number of them have been negative all at the same time, which, whilst not impossible, is statistically improbable, and we've gone through an unfortunate period where that has been the case, which has been frustrating. But it's certainly within the realms of possibility. So outside of alternatives, another question we've received is, what are the opportunities available in the marketplace at the moment? And one thing I like to point out to people is that opportunities generally exist in the face of uncertainty. So in an ideal environment, investors look for the holy grail of great investment fundamentals, brilliant growth, and a fantastic story with no bad news, but they can buy that asset at a great price. Unfortunately, that doesn't happen. To get a great return on investment in general, prices have to be low, but prices are usually low for a reason. And that reason is bad news and because of risk associated with the investment. But you have to be compensated for taking a risk. So there's always some level of uncertainty attached and some bad news. But that's why the price is low and prospective returns are high. But it's also why we diversify, just in case the worst occurs, and some of that uncertainty and some of the bad news associated with the investment ends up manifesting itself, and it ends up becoming a problematic investment, because you just never know. Whilst markets overshoot to the downside far more often than not, occasionally they're right and things really are as bad as they seem. So where is there the greatest level of uncertainty? If you want to find opportunity, go searching for where there's the greatest level of uncertainty, which seems to have been overplayed by the market, but has good underlying fundamentals. I would argue that is the emerging markets and Asia in particular, given that since around February, March of this year, that has been the area that has sold off the most off the back of Donald Trump's policies in regards to tariffs and China. Yes, there is a risk that a trade war could cause issues with the economies in Asia. Yes, there's been pockets of isolated issues in Turkey and Argentina, etc. But the broad area itself is looking perfectly fine. We talked about the Chinese renminbi falling and offsetting the majority of the tariffs that have been issued by the US. However, there's other risks associated, so even if the businesses and underlying economies of those regions do very well, there could be a sell-off simply because capital flees to another area, which is precisely what's kind of happened since February or March of this year. But that's why you get good long-term returns from investing in these regions, by taking that risk. And usually those flights of capital are transitory, and price catches up to the underlying growth. And the underlying growth in the story itself has to prevail, and the fundamentals get reflected over the long term. So going forward, we've talked about opportunities, we talked about the alternatives. If you get a chance, please read my weekly blog that talks about the portfolio, the positioning, what we've liked, how we've positioned portfolios throughout time, and what our core principles, the two core principles that I mentioned before that drive portfolio construction. So looking forward, well, let's have a quick look and recap of the past, the last number of years. Most portfolio performance can be relatively easily explained. So those portfolios with maximum market exposure, maximum illiquidity, and maximum leverage will have done really well. And I've been asked, what do you mean by maximum leverage? Well, exposure to massively leveraged property development, highly leveraged private equity and venture capital, those sorts of investments will have done really well. So if you want to look for the industry super fund that has the most aggressive illiquids allocation via infrastructure, private equity, venture capital, and the lowest allocations to fixed income and liquid alternatives exposure, they will be doing very well and will probably be the top performing funds of the recent past. However, if you think about the environment that we've existed in, we've had an enormous level of uncertainty globally. The US equity market is 9 years, almost 10 years into a bull market. It's the second longest bull market, I believe, on record, encroaching on the longest bull market on record. Based on the Shiller PE, the US is the second most expensive it has been in the last 150 years. The only time it has been more expensive was prior to the tech wreck. It's now more expensive than the GFC, prior to the GFC and prior to the Great Depression. Australia has gone 27 years without a recession. Globally, we have quantitative easing being reversed. We have obviously the trade talks that we've talked about with the US and China and the uncertainty that has fed through into the emerging markets. And so I would argue that in the last number of years, having maximum acceleration on illiquidity, leverage and market exposure would be a dangerous position, and it just so happens that it's paid off. The other thing is that growth has been the place to be, maximum growth exposure, and the areas and factors that have the most amount of practical and academic evidence behind them, i.e. value and risk management, have not been the places that have done well, even though those are the areas that have been proven over the long term serve investors the best to be allocated to. And so going forward, you kind of, where do you want to position yourself? Well, it's a question for people to ask of themselves. Do they want to be aggressive and assume the status quo will continue? And if that's the case, you want to be allocated to growth. You want to be allocated to maximum market exposure, buy and hold, or what I'm referring to as buy and hope, because you're hoping that the status quo will continue. You're hoping that the US equity bull market post-March will continue on from 10 years to 11 to 12 to 13 years. You don't necessarily need access to funds, and so you can take on some illiquidity risk. Or do you want to be the counter-cyclical or counter contra-trading to that and take on board value positions which have been out of favour? Do you want to be investing in the markets that have not performed so well, so in the last 18 months have not been roaring ahead? Do you want to concentrate on risk management and prudence, which has not paid off as well as a typical buy and hold or market approach has paid? Where do you think we are? I would argue that being second most expensive the US has been in 150 years, almost 10 years into the bull market, and with the enormous amount of money that has gone into passive strategies, that becomes a reinforcing loop in that money that goes into passive invests in those underlying passive instruments, and so the momentum is behind them and they become great and better performing assets, and it becomes a reinforcing loop. Unfortunately, that works the other way. When that cycle turns and that money is pulled out, that can move quite violently the other way, and leverage works the other way as well. And so we stand on the other side of the fence, where we believe that we want to use approaches and practices that have academic and practical evidence from many, many, many decades that suggest that prudence, value management, risk management, diversification, and liquidity, and high levels of liquidity are what we want in client portfolios at the moment going forward. And in fact, what we've wanted over the last number of years, even though that has not necessarily been the way to maximize returns, but just because nothing has gone wrong didn't mean that nothing could ever go wrong. So with that, I'll leave you, and please, if you get a chance, read my weekly blog that'll be released today, the 20th of November. Thank you very much.